welcome to the market analysis. I'm Tom Nunemaker with Jim Riggio and Stephen Shannon. Before we get started, we have a little disclaimer that Keppel Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented, but actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And we have this disclaimer on all of our pages at the bottom if you care to peruse it at your own leisure. With that out of the way, Jim, do you want me to give you the ball first? Stephen, who wants it?
Jim.
I'll be glad to.
I'm just gonna pontificate.
Okay, great.
I was actually very, very excited, Stephen. Thank you very much for coming. Stephen and I used to end up doing this all the time, Tom. We'd get on, especially, when the markets would end up moving around a lot. There is a bunch of things that happened today that, to me, were, just major. We've been having issues in and around some of the technical indicators that they were becoming more and more challenged. We just blew through everything today. And Stephen, I never shared with you, but I wrote an indicator looking at the volatility in terms of the VIX, and when in terms of trading for the VXX, being long the VXX, and it went long today. It's only gone long about 5 times since 2007. That's how brutal it was. Here, let me start to share. Share my desktop monitor. Okay. I think you guys can probably see via VIX Central.
Yes.
Okay. I figured I'd start here, because I know a lot of people end up looking at this. This is a free website. I'll show you how to end up putting it on to Thinkorswim with live real-time quotes. These are delayed, but I think it gives you a good feel for this. What it's showing you is that it's showing you where each of the VX futures are trading for October, November, and so on. And you can see that we're in backwardation, meaning that the front month is higher than the second month. Actually, we're in backwardation between the second and third months also, which is pretty major, okay? One of the things that we end up looking at, what you're looking at here, is just a website or an Excel spreadsheet that my current trading partner, after Stephen blew me up, I had to get somebody else. My current trading partner put together, and that's Ian. He spoke with you guys last week. We look at each of the months and how they end up correlating to the following month, and you can see that this should normally be a nice, gentle drop, and then it comes off almost like in a gravity type curve where it accelerates coming down. So the backwardation is in pretty ugly shape. The other thing I wanted to end up showing you was this was an indicator that I ended up putting together. What you're looking at is the VIX on the top, and let's make this a little bit higher. What you're then looking at here is the VXX in the white versus in the pink or purple. You're looking at the UVXY, right? Significantly moved. Now, this next graph here, this is the backwardation. So the green line is the 1 to 2 month, VIX futures compared to one another. The yellow line is months 2 to 3, and the red line is months 3 to 4. So you can see that if I end up going back for a longer period of time, I'm going to come back here, and you take a look at I mean, you can see that the futures have only traded, up until, they're maybe about 6, 7 months out. So that's why they don't go back further. But you can see that this here has been pretty ugly. Obviously, everything has fallen off. The thing I wanted to spend a little bit of time on is this indicator that we ended up building. What Ian, Scott, and I did is that we looked at the implied volatility. We looked at the rate of the change of an implied volatility. And what we did is that we compared a slow-moving ATR to a faster-moving ATR. This was a very similar principle, Stephen, to what you and I did with Danger Will Robinson when we first talked about the fact that the ATRs get to be larger. The way the indicator ends up working is most of the times we'll stay between a lower range and an upper range. The faster moving average of an ATR is the blue line, or the the aqua line. The slower line is the yellow line. When the slower line gets outside of the range and it's being confirmed with the faster range still moving higher, like we are today, that's the point when VXX has ended up moving it up significantly over the next weeks and months. I'll end up showing you an example. So if I take a look at, let's say, our debt crisis that we had back in 2011, you can see that when we crossed right here, we had confirmation that the faster average true range average was moving compared to the slower average true range. So my indicator is saying that we should end up getting long VXX right here. And you can see that we stayed above it, right? We got long, let's call it somewhere near 30. The next day we were up at 48. And we stayed in that range for quite a period of time. So this is telling me that things are really quite ugly at this point. And, if you're not scared for your life, you should be. Okay. The other one that Stephen and I, here was another one that I'm taking a look at. What this graph is, if we're looking at the VIX and the bar chart. Stephen, any comments about what I just went over? Because this is all stuff that I had done since we used to do this on a daily basis, you and I.
No, that's really good, too.
Okay, thanks. So what you're looking at here is a daily graph of the VIX, but the other line here is the skew. The skew as defined by the CBOE. Every day they'll print out a skew, and basically what it's telling you is how much more expensive the puts below the money are versus the calls above the money. You know that when we ended up taking a look at different skews, you could end up seeing that. Where I had always looked at the best level of skews was in a tool called Livol. And when I took here, let me just pull up the skew chart on it. Okay, and let's get rid of this so that it's just easier to see. And let's go out 25%. What you're looking at here, and let me get a few of these things up so that it's easier. What you're looking at here along the bottom is the price of the SPX. Along here is the implied volatility. So this is something, Stephen, we always used to end up looking at in terms of if we were going to end up trading, and I'm just looking 10% up and 10% down of the current price. As you go further down in price, the implied volatility gets higher and higher. As time goes by and you get closer to expiration, the further you go down, the steeper the volatility gets. You know, if I was to show you this in a vol chart, if we were to say go and take a look at the SPX, oops, it helps if I could spell. Right, and I was to open up, let's just say, next week's. When I take a look at the implied volatility, as I go down, as you'll see here, if I go down in price, the implied volatility, which is in this last column, it ends up being lowest near the money. Okay, and when I go further down in price, you can see that the implied volatilities get higher, right? You see over here how oh, I'm sorry, I'm in the wrong column right here. How the implied volatilities get higher below the money than they are above the money. So what skew is, it's basically a ratio, and you can go to the white papers from the CBOE, but it's basically a ratio of how much the puts are trading compared to the calls. The higher the number, the more expensive the puts are compared to the calls. What happens many, many times is that when you have a jump in volatility, you will come down over several days. What was very concerning over the last few days is that as we started to drop, skew has actually gotten worse. What that ends up meaning is that people are willing to pay even more money for puts. So, you know, if you want to try to catch a falling knife, and Stephen, you and I talked about this a little bit, if, you know, you wanted to end up trying to catch a falling knife, if you're great at calling bottoms, boy, you're going to be rewarded well for selling those puts if you can time it properly. Of course, you know, if you don't, it'll be like getting run over by a train. So, you know, it's not something that, you know, I would end up doing. And Stephen, we talked about it. If you end up doing that, you always do it in size where you would plan on buying the shares, right? I mean, it's not that you're over allocating to it. The last thing that I wanted to end up showing was our Old Faithful that we ended up taking a look at, and that was what we called the Danger Will Robinson. Basically what we were looking to do is that we were looking to say, how do we end up knowing when things are starting to get pretty ugly? And the answer would be almost any trader, okay, professional trader who's traded on the floor, and I've run this by almost every trader that I know, is that the daily ranges tend to get wider before you have large sell-offs. So what you're looking at on the bottom here is this is the daily range of the last 9 trading days compared to the 90 days before that. And by taking a look at how that ended up changing, we would end up getting ratios. There's a lot of noise in a shorter term one looking like 3 days versus the previous 30 days. But when you start to look at this range, they tend to end up being, you know, sell-offs. Now, I'm looking all the way back to 2007. Look at how high we are here. So only 3 times since 2007, our Danger Will Robinson has been higher than it is right now. This is ugly. This is really, really ugly. Stephen, I don't know if you want to end up adding anything to it, or? Stephen, you there?
While we're waiting for Stephen, Roger Frank, you want to look at that, Jim?
I was going to say there's a lot of things for us to be talking about, but in terms of this particular chart, which you brought up last week, and I've been watching myself quite a bit, we should have, at least halfway back in terms of trading sessions, the flashing lights should have been going off saying we're in serious danger here, long before we got these last 3, 4, or 5 days of significant sell-offs. So it gave you plenty of warning And you didn't have to wait for, I mean, to me, by the beginning of October, and October, of course, is always a month that I approach with great trepidation just from, classical, Octobers in the past. But once you get 4 or 5 days of those big red bars in a row, especially on the longer-term chart, the 990, then, long before these last 5 trading days, everybody should have gotten incredibly defensive. The other thing is, I think people got fooled last week. I don't remember who came on. They don't like to pick on anybody, so I'll pick on Paul. But Paul came on when we had that one reversal day and said he got bullish. I don't know how you could possibly get bullish in this market, especially when you start to see the warning signs. And there are some others when you're done, Jim. I can pull up my old profit chart, which you guys haven't seen in a long time. You just point out a few basic other warning signs. But beyond the technicals, and I think the presentation you did on the volatility side, Jim, is great, but that's only one leg of the stool, so to speak. There's volatility studies. I think there's technicals, which include David and Robinson, and there's some macroeconomic stuff for us to look at. And finally, because of what's gone on since mid-2008, 2009 with the Fed, you always have to take a look at what's going on with the Fed and how the Fed is affecting the market as well. So you've got all these other factors that you have to, start to factor in. And, I think we could spend a little bit of time talking about the other indicators as to why we should expect, a further, probably bigger correction. I actually was hoping we had an update today so I could come on and start, running around like a chicken with my head chopped off, waving my hand saying, the sky is falling, the sky is falling, before the sky falls. But then everybody would say, look how smart he was. But now I look like, just another, the sky already fell. So this is, hindsight. But
well, Stephen, on that day, if you remember, and this is something that the week before when Ian Scott was on, we talked about, and it was the 150-day moving average on the SPX. It has been tested and held a whole bunch of times, and we ended up saying below this range, okay, watch out. And that's what ended up happening. Is like once we touched it, this was the day back up. But I mean, it's been just absolutely ugly. This is the 200-day. The 200-day having support at on Friday is where we closed, and then we broke it again. At this point, I mean, you can start to take a look at the chart, and we're going to have to end up drawing some, Fibonacci retracements. But, right here, this is an absolutely critical level. If you take a look at this level right in here, and we highlighted, right in here, you can end up seeing that it acted as support here. It acted as resistance right before it, right around this, 1875 level. After this, there's really not a major level until we end up getting down to, 1820 or so, 1812. I mean, there's a pretty big, air pocket, going down. We just did this, climb up, and there's no resistance. I mean, there was no real heavy-duty resistance above this, so we're probably going to end up, it's looking ugly. Stephen, do you want to share your desktop? You want to show us the graphics you've been looking at?
Yeah, we can do that too. But let me just say that breaking the 200 today was a very significant move on the S&P by far, the S4. And as you said, there isn't a lot of the things to look at technically below here because, the market's had this sustained run, for quite a long period of time. And so you really wouldn't expect there to be a lot of support because the market's been pretty much, one way. And as you're looking at this longer time frame that you've got up there, really around that 1400 level is one area, the 1600 level is another area. But those are just areas of prior support and resistance, which are the least powerful of technical indicators to provide actual support and resistance. We know that the moving averages are kind of a self-fulfilling prophecy because everybody's watching them. So if everybody's watching them and you violate a moving average, everybody starts to take action saying, oh no, we're below that moving average. So when it comes to kind of the art of support and resistance based on prior highs and lows, that's not nearly as strong an indicator of what the market's going to do than what we experience today. So there's, as you said, there's a big air pocket down there, and I don't know that any of those prior support and resistance levels really need a hill of beans at this point.
Yeah. Now I got to tell you, it's a scary market, and there's a lot of stuff on the macro side. It is to me a little bit interesting that this is happening right before earnings season. Because with earnings, coming out in very big fashion this week, it's going to end up making a huge, huge difference. I mean, if I just take a look at it, tomorrow you got J.P. Morgan, Johnson & Johnson, Wells Fargo, Citibank, CSX, Intel, and then a couple other transportation companies. And then it just gets busier from there. And that's tomorrow morning before the open.
Let me interrupt you for a second because the earnings, earnings don't mean much compared to what they used to mean because in this environment that we're in, with these artificially low interest rates, most of these corporations can produce earnings because they can borrow all this money really cheap, long term. So their earnings are not that significant to me. If they have good earnings or bad earnings, I don't think they're going to drive the market as much as they used to because we're in this artificial environment where the market's floating on this lake of liquidity. I think of it more like Kool-Aid, but we're floating on this lake of liquidity provided by the Fed, and all the corporations out there are sitting on a bunch of cash and can do can finance their balance sheets with exceptionally low rates. And so, the earnings can be distorted, is really all I'm saying. So while it's true we're coming up on earnings season, that has kind of less of all the legs of the stool right now, that's the one I care about the least. Unless, of course, all of a sudden you start getting a slew of bad earnings reports, then that'll, of course, drive the market. But, I think there are all these other things out there that have much more of an effect on the market than earnings do right now. Particularly what's going on with the Fed. We've got, not just our central bank, but central banks around the world taking on massive amounts of debt, and floating out currency and restricting money. You've got Europe and Japan, particularly when we look at Germany, like I forget his name last week, is saying wants to back, and you start to see Europe sinking back down, looking like, they may go back into a recession. The fact of the matter is, who believed that Europe was fixing itself? Anybody that believed that was crazy. And there's just no reason to expect them to fix themselves. Japan's now the leader of the Kool-Aid gang. So we're going to have all these countries with a race to the bottom to debase their currencies. You've got trillions of dollars in debt out there. You've got a market that has had this huge run, artificially supported by all this liquidity coming out of the Fed. And so tell me what there is to support this market. I gave you a whole bunch of reasons why this market can sell off significantly from here. Give me a bunch of reasons it's going to drive this market higher, other than the fact that I'm a great contraindicator. So when I say the sky is falling, then probably the market's going to take another leg up.
Yeah, it's we were talking today, Stephen, and we agreed. We probably have 2 units of risk to the downside for one risk, one positive unit up, and it can end up being even worse, and it can be very, very quick. I mean, you've seen that we sold off over 100 spook points in the last 3 days.
Yeah, I mean, it's been big. We've been making lower high, lower lows. We've violated all moving averages in a very short period of time. the market is showing us incredible weakness going into October, which has traditionally been a time when the market seems to want to sell off. So I don't know where we are today. I didn't calculate it, but I know that I think on Friday, the S&P gave back something like, it was still up to about 3% on the year or something like that, even though it gave back 3%. By today, I think, that's probably all gone now. And, I think the Russell didn't do as badly because they've been leading the way to the bottom. So, all I'm asking is, somebody should tell me where the buying power is going to come from, other than the banks are going to still print money. And maybe when the market sells off like this, we'll get more conversation out of, the Fed saying they're going to delay interest rate rises, or if it's really bad, maybe they'll announce that they're going to delay their final, the final end of QE for another quarter or so, or another 1 month cycle for the FOMC. Who knows? Because their whole approach to, reflating our economy has primarily been to reflate people's balance sheets based on the market. So, of course, the rich people feel like they've gotten rich and are spending more money, but they haven't really helped the overall economy by doing that, and in fact, they have hurt it.
Right. So what to do about it? This was a trade. Okay. This vertical. This was a trade that we had put on. It's just the model that we had put on in our volatility opportunity fund. What we look for when I was going through this with Ian today, what we look for is the following. We were looking for something short term, okay, that could end up having a significant bounce up. But when we took a look at the market, we didn't think we were going to stay where we were. We were either going to take a major leg down, or we were going to end up ripped back up. One of the two things were going to happen. So what we ended up starting to look at is that we went out and we said, okay, by Friday, what's going to end up happening? And we ended up using the VXX. You can use the VXX or the VIX, okay? And the reason why we really like this is that if you go and take a look at the calls on the left-hand side here, and you take a look at the implied volatility, you can end up buying something out of the money. Like when the VXX was at 35 and change today, we looked at buying the 37.38. We were $1.50 out of the money, okay, and we paid 29 cents for a dollar-wide spread. So we thought one of two things happened: either this thing, falls apart, or it recovers completely, right? One of the two. So we looked at this as a trade where we probably had a 50-50 chance. Now, in hindsight, we had better than a 50-50 chance, but it really was a coin flip. But we were risking 29 cents to make, the rest of the dollar. So we were risking 29 cents to make 71. You give me 50-50 odds, okay, to bet 29 cents to make 71, and we'll send that in all day long. So when you take a look at how to end up hedging, doing something where you can buy lower volatilities and sell higher volatilities, and when we had done this, there was about a 10-point volatility spread between the two, a little bit less. But those are the types of trades that, when I take a look at how to end up protecting long positions, that people get absolutely killed on, is that when the market starts to go down, they'll buy puts. If you don't want to end up using the VXX because, I think that it gives you better rewards, you could do similar type stuff in the SPX. You could end up taking a look at the puts, and that's over here in this column. You could end up buying one put, okay, below the money a little bit, and selling something a lot higher. You could buy something with a 25 vol and maybe sell something with a 27.5 vol. It's a reasonable trade. The reason why we liked the VXX, okay, trade better to be able to end up putting on as a hedge today was because when I take a look at where the backwardation was, right, and if I go back just to the VXX, the VIX Central chart, because the backwardation was so steep, you know, we felt that we had a, at the time it was only about 3%, but we felt if it goes down, not only will we get the movement and the increase in volatility, but also the increase in backwardation push up PXX higher. You know, we could have also done it in VIX.
Well, you know, just in general, I mean, yeah, the way to approach it is clearly, you know, trying to sell the proper SKUs in volatility products. But just from a general perspective, the fact that the VIX has gone from 11 and change to 2460, whatever, it closed today at the bottom at 2460, you know, should be telling everyone what's going on in the market. You know, they're widening the spreads, they're jacking the volatility, and there's now a tremendous amount of fear coming into the marketplace. So, yeah, I think you just have to be exceptionally careful as to what kinds of positions you get yourself into, you know, that are volatility sensitive, because from this point you can see both an additional, you know, move down in terms of price action and delta action, but another spike up in volatility. So you have to be very careful what positions you put yourself in. Make sure you've got enough hedge so that when the vols keep rising, you've got some of those, you know, out of the money options backing you up against your shorts. Even if the SKUs have gotten large and they're costing more than you would normally like to pay for that. So, kind of a general perspective, like you want to look at. And you've been spending just a lot of time, probably the last year, you've been spending all of your time on these volatility-based trades. So this is kind of, you know, your once in the, we've had these big spikes, what, 4 times or 5 times in the last 4 years. So here's your opportunity to shine.
Here's what we did in the VIX, and it was a horrible fill. We messed up dramatically on one of the long, on the 32.5. But what we ended up doing is that we basically did a back ratio, okay, where we take a look at where our center is at 30. So we ended up buying 100 of the 25 and sold 150 of the 30. Now, this was a leftover trade that we had from a long time ago, where we had just bought the 32, sold the 35. It was a horrible trade, but, you know, when I take a look at them together, you know, to me, this is a hedge, right? You know, where if you're risking $7,000 and it runs up, you know, you're going to make over 30. So, you know, those, you know, 3-to-1, 4-to-1 risk rewards that have limited downside, and that's the key, because you're 100% right that if this thing does reverse, watch out. I mean, you can get absolutely slaughtered if you are just net long, like the UVXY or the VXX. But if you do it in a spread where you're risking 1 to make 4 if it runs against you, if it goes back, that's great because it's going to end up helping your other position. But, you know, overall, these are the types of hedges that on days like this, especially because the SKU didn't end up helping. Normally what ends up happening is that the SKU, meaning goes way out of the money. You know, the theory goes as follows. If the market drops 10%, what's the chances that it drops another 10%? So usually when you take a look at the money versus the 10% below the money, that the difference in vol might not be as bad, let's say, on the SPX puts after such a big drop. Because the calls are going to be more money because people think, oh, we might snap up much, much higher. So the difference between the calls above the money versus puts below the money, or skew, tends to flatten out after the drop. That didn't happen today. So for the verticals, I thought were the best risk reward. You know, we went through and we analyzed, you know, in the morning, what do we end up doing if we have another pullback? And these were the structures that we had come up with earlier in the day. Stephen, you want to share any graphs, or you want to end up sharing anything
I kind of picked, I can. I kind of picked off of yours. So, I've kind of said everything I need to say, the graphs that you have up there in terms of technicals. I just want to reiterate one last time, the technicals are, while they're interesting to focus on, and, we hope to find, particularly with things like Danger Will Robinson, which, we spent a lot of time on together a year and a half ago. Those kinds of things help a lot. But again, it's only one part of the overall picture that you have to look at as a trader. You have to start making some assessments about what is the trading environment that you're in. Is this a time to continue buying the dips? Or is this a time now to really get defensive? And both from a technical standpoint and a macroeconomic standpoint and the unusual condition of having central banks around the world affecting how markets perform, you have to take all that information and try to make your own informed decision about how defensive you should be at this particular point in time.
Yeah, no, I agree totally with you. But by the way, it's Tom. What was it? It was 2 weeks ago when we were talking about the macroeconomics and what was going on in Europe. Okay, what we had seen just in the bigger picture in terms of interest rates and quantitative easing. And one of the questions that we got asked was, how important are the macros for an intraday or a swing trader? And the answer is, I think, for an intraday trader, maybe not too important, but for a swing trader, you need to know that there's an increased risk, okay, that if things don't go well, if they don't start to correct, and if it gets worse, that we see a significant drop. And one of the things that I end up taking a look at, these were things I know you and I, Stephen, talk about on a fairly regular basis. But then people end up to start saying, well, is it because of the Ebola? No. Or is it because of some other, short-term issue? It's much more structural. What you'll see a lot of times when you have these structural issues, there might be some short-term catalyst that sparks some selling. It's the Archduke Ferdinand, syndrome, I call it.
That's a good video. That it's kind of
my dumb jokes.
But, things like Ebola this could actually have the opportunity to morph into something much more significant in terms of global trade and global markets. And countries start restricting flights and people stop traveling. I'm supposed to go to London in November, and I got to tell you, I'm thinking seriously about not going. Between that and what's going on with terrorism in the world, they can have somewhat of an impact, on the markets, but they tend to be short-term. And most of the time, I think the talking heads are just searching for, some reason to explain what's already taking place. And the points that I made earlier, tend to, I think, carry a lot more weight.
Stephen, and I'm sorry, with the speaker, I didn't hear. Where were you thinking about not going?
London.
You're not going to go to London?
I don't know. I'm thinking about not going. I am.
Is this story?
Yeah, it's a double-edged sword. First of all, I don't know that I want to get on an airplane at this point in time. And second of all places to go, London's like a major hub for people traveling all around the world. And I also think that, if there's going to be a spout of terrorism coming out of the Middle East, that they'll probably go after Europe first, and London is a prime target for them. And if I go to London, I'm going to be in a stadium environment with 30,000, 40,000 other people, which is an interesting target. So I don't know. I'm thinking about it. We'll see what happens in the next couple of weeks. But if I'm thinking about it, other people are thinking about it. And,
Dorian can't help you with the stadium, but maybe he could stop and pick you up on the way.
Say that again?
I said, Dorian can't help you with the germs in the stadium, but maybe he could stop and pick you up on the way.
Maybe.
So it's it's just everything seems to be hitting at once. And, you know, unfortunately, okay, when rates are already where they are, central banks around the world don't have the ammunition to end up lowering rates to be able to end up moving things higher. They've already shot all of those bullets and then some, okay? It's, you know, with the quantitative easing at this point, they're trying to end up, you know, putting that in the rearview mirror. You know, do I hear, you know, QE4?
Well, that's a good question, Jim, because, you know, let's say that, and I'm not saying that I think this is going to happen, but just for the sake of discussion, let's say we have a 10% correction from here. You know, how do you think the Fed's going to react? You know, they'll do something, you know, in terms of trying to re-stimulate the economy, and who knows, maybe they'll, you know, do a 180 and start QE4. I mean, it's crazy the way they think, and so we've got Europe, we've got Draghi in Europe who's trying to get QE going there. We've got Japan with QE going, you know, both barrels. And the only place really where QE is unwinding is the United States. And if our markets really start, you know, to take a hit to the point where so-called wealth effect trickles down, who knows what they're going to do?
You know, the comments about both barrels, Abe Economics, okay, in Japan. But when you take a look at their bond purchasing program compared to their GDP, and then you take a look at their debt ratios to GDP, I mean, a lot of people didn't realize this, but Japan's debt to GDP was worse than Greece's when Greece was, you know, in the process of defaulting. And Japan's a lot bigger. If we have a blow up of that magnitude, the markets can be truly ugly. I mean, and you take a look at where we are now. You know, I showed you on both the Danger Will Robinson, then also on the volatility. I mean, this has only happened, you know, anywhere from 3 to 5 times since 2007. And we had some really major, hideous pullbacks during that time.
Right. And the other thing, Jim, is that during that period of time, the central banks didn't have trillions of dollars of debt on their balance sheets. They hadn't driven interest rates down as low as they are today. And you don't have the kind of corporate and government debt around the world that we have hanging over our heads. And there's a lot that can unwind here. You know,
it's true. You know, because the thing is that...
Let me just say one thing. You know, a lot of people, probably myself included, were thinking similarly to this 6 months ago, 8 months ago, and yet, you know, the market kept rallying, so if you took action prior, you know, to the last leg, you would have missed the last leg up that we've had. But it seems to me that this is the last leg up. That's my feeling right now. Fortunately, you know, I took a lot of steps prior to October. You know, I raised a bunch of cash prior to October. But nevertheless, you know, look, nobody knows for sure. You know, you can only go by what you see out there and, you know, what kinds of information is available to you. And as I said before, there's a lot of information as to why these markets can have a significantly move down or a really significant correction. And I don't see a lot of reasons to support the market.
Yeah, no, neither do I. You know, I know that, you know, by the way, I've mentioned John Malden on several occasions in this WebEx on Mondays when we talked about macros, and you know, Stephen was the guy who introduced me to him. You know, when you read Malden or other things in and around the debt issue that you talked about, what really happened coming out of 2008 and into 2009 was basically a massive shift of debt from the private sector onto, you know, the Fed's balance sheet. We never really solved, okay, total issues. When you end up taking a look at where we are, I do think, okay, and Malden's been saying this for months, that, you know, we have pain to go through right now. But once we end up correcting, now it could be a long time before the correction, once we end up correcting, you know, there does appear to be some really great long-term technology. Whether you look at all of the advances in some of the big data stuff and what that's doing, okay, to just corporate profitability, you take a look at what's going on in the medical field. So you know, when I look at this longer term, we have, you know, in a 10-year horizon, you're probably in a pretty good shape. But do we have some ugliness for the next month, the 6 months? Yeah, probably.
Yeah, but we're here talking about options and options trading. This is a short-term, you know, very perspective.
Right.
And the question is, what kinds of macro economic things can affect the markets for us as options traders? And that's what, you know, I tried to outline as best I can. You know, as to what is the environment, how should you be thinking about this environment as an option trader? You know, what does that mean for the positions you put on? Are you going to, you know, you don't walk away from the market, but you have to be more defensive. You have to put on more hedges, similar to this trade that you have up there right now. You know, you can, you know, ratio your protection. And, you know, we've heard many times the best protection in a market like this is just plain old long puts. So having some extra long puts lying around doesn't hurt either. The whole purpose of the conversation today is really how should you be thinking as an options trader as you're looking at the trades that you have on and trades that you're considering putting on over the next, you know, few days and few weeks.
Right, you know, the thing is that when you take a look at one of the trades, and it depends on where you are and what your objectives are. But, you know, I love to end up doing something like maybe, 4 by, or I did it backwards, 4 by 5 spreads where I'm, and I did that with the puts, and I did that backwards, right? That should have been 5. Let's try that one more time. We are selling the back ratio. But if you do something like 1800 or even say 1775, and I do something maybe, you know, a 4, or even maybe a 2 by 3. Okay. You know, I love trades like that. Normally, you know, and what I originally said, if you're going to end up being a hedge, let's try it one more time, a 4 by 5. You know, something like that, because what ends up happening is you're selling just a ton of juice. You know, that volatility is much, much higher down here. You can see I'm selling at 25, but I'm only buying at 22. If that's not far enough down, you know, if you end up looking at something like this, okay, you can end up having quite a significant amount of protection on if you end up having the pullback, and you can end up shortening your time frame too. So, you know, you take a look at what your different options are or your different alternatives to be able to end up putting, you know, your short-term hedging in. And it's, you know, it's a very, very, with the vols this high, it gives you a lot more opportunity to look for, you know, 2 to 1, 3 to 1, 5 to 1 payouts for your hedging. You know, the other thing that sometimes you end up taking a look at is even doing something like this, is doing a calendar, right? If I buy a calendar, or I'm sorry, let's do a diagonal. We'll pull this maybe in the beginning of October, and we can kick this thing down. and I did in the wrong direction. And if that's too far, you know, you might even want to end up ratioing something like this where, let's say if I buy 5, but I have to customize it. But I only sold maybe 3 or 2. I could put and so forth. Right? But doing something like this, because, and here's what ends up happening, people never quite understand this. If we drop another 10%, vol's going to go up even more. And so if I take a look at this and I do volatility turns here, take volatility steps, look at what happens if vol goes. Now, granted, I know they're not going to go up in the front month as much as the back, so this overstates how much it goes up. But even if I was to end up taking a look and looking at the fact that the front month would go up more than the back month, it's a long Vega trade. Do I like getting long Vega at this point? I prefer not to. You know, that's why, you know, with the vols at this level, this trade doesn't get affected as much by vol. It's more of a delta trade. So at this earlier on, I like the other trade because the thing is that it makes money when vol pops. So not only is it a delta hedge, but it's a Vega hedge. You know, in our with the guys up in New York that I told you about, Stephen, you know, we cut about 65% of the pullback in the SPX. We cut that out today because of that volatility hedge that we had on our S&P 500.
Right.
So you know, the thing is that this is why it kind of drives me a little bit crazy. People always end up asking for rules, but you got to know what market you're trading and what the skews and what the volatilities look like, and you have to be saying, how can I end up getting the most protection for the least amount of risk if I'm wrong?
Okay.
And that's what we look at. Tom, are there, it's hard for me to end up seeing, do we have any other questions?
We just had a comment from Roger, but he's already left. He had to go. Talking about he's using VXST, a weekly VIX, and the VIX on a 1 and 2 minute chart, and also kind of using it to predict how the VIX is the direction of the VIX. He just mentioned the Line Yates VXX trading system, and he said Ugly is very, very profitable. And
Ugly is profitable, and you know, that's what I ended up doing with this indicator that we ended up building. I'm sorry, it's not here. It's you know, what we're trying to end up doing is that Ugly can be very, very profitable if did his indicator swing to long VXX? Did Lynn's indicator, because I know that he has been short the VXX or long the XIV for 2 years.
yeah,
And
I think I saw one that they had a signal or were getting ready or close to a signal, so he must have changed direction either today or yesterday.
Yeah, that's what I ended up seeing was that I made that signal that ended up changing the RVol stuff. Oops. This one, I purposely made the signal to end up going a little bit slower because I wanted to end up having when things got to be truly, truly ugly. And, you know, we hit it today. Like I said, it's only been hit 5 times since 2007. So at this point, you know, I think that we definitely have transferred from a buy the dips to a sell the rallies marketplace. Stephen, would you agree with that or add anything to it?
I do agree with you there, Jim. I do. I think, you know, I hate to make market predictions, but that's my feeling based on everything I can see.
Yeah, predicting is very difficult, especially of the future. It's a quote. I don't remember who said it.
We did have another comment from Tom Hughes. Said, Jim, I believe you like to play vol contraction in December. What are your thoughts on setups for this?
Okay. You know, setups for vol contraction, and I would like to end up playing a vol contraction, but not from here, from a higher level. One of the things that we'll have to end up seeing, and to me, the greatest thing to go and take a look at for something like this is to go and take a look at a longer-term chart. If I end up coming here, and let's just take a look at a basic chart and go back to the VIX. And if you end up taking a look at what happened in 2008, okay, you know, we can stay up here for quite a time, but not from a VIX in the upper 20s or even 30. You know, you take a look at where the VIX came down from here, and we actually hit 90 at one point. I knew a lot of folks that were selling vol during this period, right? They were selling vol at 20 and 25, but they were buying it by the time we got to 30 to 35, and then you can see what ended up happening. So I'm not going to play any vol contractions because I think that, you know, we could be in this type of area if I compare it to where we were in 2008. Do I play a vol contraction if we're up at 70, you know, in a couple of weeks? Do I play a vol contraction for mid-January? Oh, definitely. But I'm not ready to end up putting anything on yet here. If you do play a vol contraction, the challenge is that I love to play vol contractions in the VXX because for everybody, I think most people end up knowing, we've talked about this a couple of times, but the VXX has a couple of things that make it go down over time. Maybe we'll do a separate like educational WebEx on it so people can understand it. The challenge is that when you are in the process of pulling back, you can end up having backwardation hurt you, not help you. Okay, this is not from 2007, but if you take a look, here was just a little blip up in 2009, and you know, you take a look at say this period. Okay, and we're looking at here at 2010, right? We had the debt issue, right? The debt ceiling issue in 2010. That's what this was. You can end up seeing that it can take a long time when you're in backwardation. The way you can end up finding backwardation, we actually have all of the data, and we run our own studies on all of this stuff. But for those people that don't want to end up spending the money on the data and going and doing the test, you can end up doing it on either you know, OptionView, or if you use whatever it is, OptionNet Explorer. But you can also come over here. So, like for example, if I go and I take a look at what happened in 2010, right? October. Was it 10 or 11? I always mess that up. It was 11. Right? I can end up putting in the date here, 2011, and look at August 1st, and I can see what the volatility looked like on here, and I can see what the term structure looked like, and the fact that we were still in contango. And one of the things I can end up doing is that I can walk through what happened day by day.
Jim, I'm so sorry, but I'm going to have to go for a minute or two. So.
Stephen, thank you so much for joining us and talking about this. Hopefully, okay, you know, we can end up making this a semi-regular thing if you'd have time, maybe once a month or so.
Okay, that'd be great.
I'd like that.
Yeah.
Thank you so much, Stephen.
Thanks, Stephen.
Bye, Tom. Bye, Jim.
Okay. You know, and when I take a look at where we were on August 4th, now remember, we ended up having, you know, a debt ceiling, you know, what's going to end up happening? Kind of like we have right now. What's going to happen with interest rates? What's going to happen with bonds, both in Japan and in Europe? And you can see that we were in backwardation for months. And if you take a look at what happened from August 4th on, if I come over here and I take a look at this, from August 4th on, when things started to get ugly, you can't play a vol contraction at this point. Things have to get uglier. And one of the things that we ended up taking a look at, here's one other comment. People make a comment whether something is, if it's in a pure backwardation or contango. All we mean by that is, what's the difference between the first month and the second month? If the first month is higher than the second month, that's backwardation. If the front month is lower than the second month, then that's contango. Those aren't absolute levels. You have to end up learning how to end up trading. Okay, is it coming down? Is the threat still here? Is there going to be anything to end up going up? You know, I don't know when that's going to happen, but it's not going to happen tomorrow or the next day. It's definitely not going to happen in the next few days. At some point, beginning of November, you know, maybe closer to Thanksgiving, you know, we can have those conversations. But in my opinion, there's no way we have that conversation before Halloween, before the end of the month.
Right.
Anybody disagree? Anybody else, you know, want to end up commenting on it? You know, I see some traders here that I know are extremely good.
No, the only other comments from Brad Hartman, I think he said, I think it did swing positive in the last couple of days. I think he's talking about the Option View VXX system. And then he said, I was on vacation, so as always, the market dropped hard. So sorry, Brad.
Brad, we've talked about this. You're supposed to send us an email before you go on vacation. You promised us last time. Okay. We'll forgive you this time, Brad. Okay.
So Jim, that's it. So thanks for the great analysis, and I hope everybody's weathering the storm.
Yeah, just make sure, you know, be protected out there, people. It's dangerous. Have a good week. Who do we have on this Thursday, Tom?
This Thursday we have Joe Cusick from Trading Block. He used to be the head of education at Options Express. And then next week we've got Larry Richards from Quanti Carlo going over their new option backtesting tool that I think they're going to roll it out next month. So some good speakers coming up.
Yeah, I've spoken, as you know, both of us have spoken to Larry. I've also spoken to David Welch. You know that Dan Harvey was also involved somewhat. I spoke to Pat Ryan, who's also been involved. Very impressive, everything that I've heard. I haven't gotten to play with the tool yet, but I'm really, really looking forward to that. And then the other thing that I ended up saying, if you guys want, we can end up doing, and I can't do it this week, but I can make time next week, I can end up doing kind of like an educational thing on the volatility-based products. I've had to do this for several people at TD Ameritrade. One of the companies that we deal with are on their Advisor Direct program, and some of the advisors had asked us to end up speaking to people who had done nothing but taken long or short positions in the VXX or the UVXY. They will work, you know, very differently in different markets, and so one of the things that Ian, Scott, and I have been doing now for months is doing a ton of analysis on it. So maybe what we'll end up doing is that we'll share some of the findings over the next couple of weeks if you guys are interested.
Oh, I'm sure people would love that. We did have one more question come in from Rod. He said, is the Danger Will Robinson indicator proprietary, or can you show us how to build it?
It was actually built by a trader who's also written a bunch of papers by the name of Dave Walton. Dave ended up building it for us on that exact reason. Now, the problem is that it's such heavy-duty math that you end up having to, you can't end up just writing code for yourself. He ended up having to do a bunch of stuff outside of, and do a lot of the mathematical calculations. Let me just pull it up real quick and I'll show it to you. And if I can share it, I'm more than willing to. I won't be able to share it now with the way things are. Tom, do you know how, I've seen this share grid thing. I just don't know how it works. Like if I come
Yeah, I'm
over
not
here,
not much, so I'm not much help here.
okay. If I go to Edit Studies and I end up pulling up the, by the way, the DW stands for Dave Walton. Okay, and I come over to here. Right, can I do this? Can I edit it? There we go. I have the code, and what I can end up doing is that because it was basically my trading concept and 100% Dave Walton's work, I'd like to end up shooting him an email to make sure it's okay to share. He said it was okay to share with the trading groups that we had done at the time. I don't know if that's still the case. If it is, I'd be more than happy to end up sharing Dave Walton's work. So, but it is a very, very strong product. And oh, by the way, for those of you that know, do you remember the award he won recently?
Which one?
Dave Walton won something. He won some award for having the best white paper of active managers. That's it. Thank you, Brad. It was the North American Active Investment Managers. I think that's what the NAAIM stands for. He wrote a great paper on the stuff, all right? Really, really strong trader. Also a, hey, I got that one right, okay? My Magic Decoder ring works okay for acronyms. He also used to end up being the lead engineer for Intel on their solid state products. Right, so just a really, really brilliant guy, really nice guy. We haven't spoken very much recently, but I'll shoot him an email, and if I can, I'll share that.
Fantastic. And lastly, before we go, don't forget about the trading group on Wednesday at 8:30. I did speak to Dan Harvey, and I don't know if he can join this trading group, but he said he's going to try and join one in the near future. So that should be interesting.
And for those of you who don't know Dan, Dan was like the, if not the senior. It's like when I started, okay, in Sheridan, Dan and Steven were probably the two most senior traders. I owe a lot to both of those gentlemen. They were very, very free with their time, and I owe them both a great debt of gratitude. So thank you.
Absolutely. All right, I think that's it, Jim.
I will see everybody hopefully on Wednesday when Paul Demers and I do the Wednesday night trading group.
Sounds good. We'll see everybody on Wednesday.